If you're an investor, you've probably asked yourself this question a million times. Do I chase that explosive growth, or do I play it safe and go for stability? It feels like a constant battle, right? Well, in this explainer, we're going to break down a really smart, modern strategy that's designed to give you the best of both worlds. Okay, let's dive in.
So this is the classic dilemma we all face. Do you pour your money into those high-potential small-cap stocks, knowing full well they can be super volatile? Or do you stick with the big, established large-cap companies, even if it means their growth is kind of slow and steady? It really feels like you have to pick a side.
And here's that trade-off laid out plain and simple. Large caps, they give you stability, but you might miss out on those big, exciting returns. Small caps, on the other hand, promise that incredible growth potential, but man, they come with some serious risk. For a lot of us, this choice can be paralyzing. But what if you didn't have to choose at all?
To find that solution, we first need to get our heads around a really powerful concept: passive investing. It's a foundational strategy that pretty much flips the whole traditional idea of stock picking right on its head. You see, the heart of passive investing is the index fund. Think of it like this. Instead of trying to find the one single winning horse in a race, you just bet on the entire race itself. An index fund simply buys all the stocks in a major market index, say the Nifty 50, and its goal is just to match the market's performance. There's no guesswork involved, just broad, simple market exposure.
And get this, here's some hard data that might actually surprise you. The majority of professional fund managers, the experts who are paid big bucks to pick winning stocks, they actually fail to beat the market average over time. This just goes to show that simply matching the market with a passive fund is often a much more successful and reliable strategy in the long run.
And here's another absolutely crucial point: the cost. Active funds, well, they charge pretty high fees for all that stock picking expertise. Passive funds, on the other hand, because they're just tracking an index, have incredibly low fees. Now, that difference might look small, but over decades, saving that extra bit every year can literally add thousands or even tens of thousands to your final portfolio. That's the power of compounding at work.
Okay, so we've got our first ingredient, low-cost passive investing. Now let's add two more powerful concepts to the mix: Flexicap and something called a fund of funds. This is where it all starts to come together.
A Flexicap fund is all about freedom. I want you to imagine a fund manager at a giant investment buffet. A typical large cap fund can only eat from the large cap section, but a Flexicap manager, they can pick the best dishes from every section, large, mid, and small, depending on what looks most delicious. It's a dynamic way to capture opportunities anywhere they pop up in the market. And the result is that your investment isn't just locked into one little corner of the market. You get a balanced, diversified portfolio that blends the stability of those big, large caps with the growth potential of mid and small caps, all inside a single fund.
Now for the final piece of the puzzle, the fund of funds, or FOF for short. This concept is just beautifully simple. Instead of buying individual stocks, an FOF buys other mutual funds. Just think of it like a basket that holds other baskets, and each of those smaller baskets holds different stocks. It's diversification made incredibly easy. So how does this actually work for you? It's a really simple three-step process. First, you make one investment into a single fund of funds. Then, that fund automatically invests your money across a whole range of different low-cost passive index funds. And finally, those index funds hold the actual stocks, giving you instant, broad exposure to the entire market. Simple as that.
Okay, so we have all our key ingredients: low-cost passive investing, the freedom of a Flexicap approach, and the amazing simplicity of a fund of funds. Now let's see how these all come together in a real-world investment solution.
And here it is, a perfect example of this entire strategy in action. The Motilal Oswal Diversified Equity Flexicap Passive Fund of Funds is designed to bring all of these powerful concepts, passive, Flexicap, and fund of funds, together into one simple, accessible product. So let's just recap the core benefits here. What do you actually get? Well, you get broad market exposure with just one single investment. It's automatically diversified across all company sizes. It's built using the power of low-cost passive funds. And most importantly, it directly solves that growth versus safety dilemma we started with. This strategy is also backed by a really credible, time-tested philosophy. Motilal Oswal's buy right, sit tight approach is all about buying quality at a reasonable price and then holding on for the long term. This isn't about chasing quick, fleeting trends. It's about disciplined, long-term wealth creation.
And what's more, this kind of sophisticated strategy is incredibly accessible. With a minimum systematic investment plan, or SIP, of just 500 rupees, it's really designed to empower investors at every level to start building wealth the smart way. So, let's wrap all of this up and focus on the key takeaways. Why is this combined approach so powerful for a modern investor? For you? It really just boils down to three huge things. First, simplicity. One fund, one transaction, and you're covering the entire market. Done. Second, diversification. You're not overly exposed to any single part of the market, which is a huge deal for managing risk. And third, cost effectiveness. By using passive funds, you keep more of your money working for you, not paying it away in high fees.
The really crucial takeaway here is this: you no longer have to be stuck choosing between growth and safety. A strategy like this offers a powerful, balanced solution. It's really about investing smarter by diversifying your portfolio with a single, highly effective tool. And that leaves us with one final thought to consider. In a world with endless investment options and so much complexity, could a single, well-diversified, low-cost fund actually be the key to simplifying your entire path to long-term wealth? It's definitely something to think about.